Hey guys, how are you doing? And welcome to the inaugural Boardwalk Real Estate Podcast. I got my man Marc Papineau here. So what does this podcast really aim to do? Obviously, if you've met either of us, you know that we're really invested and engaged in real estate. So the point of this podcast is to bring on an expert to give you guys real world practical knowledge on all things real estate. And we're lucky enough to have Mr. Marc Papineau on the podcast today. So maybe in terms of a first question, Marc, maybe give yourself a bit of an introduction and maybe talk about your real estate experience. And I know the specific sort of theme for this podcast, something I know that you're very fluent in, was the rental market and investment properties.
Sure. Thanks for that warm introduction. So a little bit about me. I've been obviously involved in real estate for roughly 11 years, maybe a little bit more now. I've lost track. And very, very early in my career, like I'm talking about ground zero, like month one, I decided that my niche market was going to be rental properties. So basically on the ground floor of my career where I was establishing my base and deciding what I was going to do, my decision was rental properties, development, and everything in between that, essentially focusing on helping people build wealth through real estate. And fast forward 11 years, I've sold somewhere around, I've lost track, but $500 or $600 million worth of rental properties.
Amazing.
Buying and selling. Yeah. And I've had the opportunity to work with some incredible people, some phenomenal developers, people that are now leading the city in developments. And I've had the opportunity to learn from these incredible people. And I'm passing that knowledge along to anybody who wants to listen or everybody's looking to invest in real estate.
Amazing. I'm sure it's changed quite a bit. How would you, I suppose, gauge when you first started maybe a decade ago and then how the market is? How has it changed over the course of, I suppose, a decade? Maybe it was a bit more Wild West or back in the day. I know certainly, I think I had seen a statistic that it stated that in 2021 on the Ottawa Real Estate Board, that 30% of all purchases on the board were investors, which is a crazy amount to me. And I know, you go back to the 50s and probably, people looked at buying a house as a home. It's much more of a speculative asset now. I think everyone's sort of in on the fact that, if you want to build wealth, it's one of the best ways to do it.
Yeah. It's a loaded question. There's so much that goes into it. But yeah, definitely how the residential resale of multi-res or commercial multi-res has evolved over the last, say, decade, has transformed quite a bit. I mean, as a whole, there's always been a pretty healthy demand for rental properties. I feel there's a huge shift in who's buying rental properties. 11 years ago, it was quite common that you had developers or, like you say, the Wild West, people that are willing to venture out into kind of no man's land and take risks and buy rental properties and they had no idea what they were doing. But it wasn't common practice. Like the bulk of the people that I was working with were professionals, right?
Savvy investors. And are you starting to see a shift now? More mom and pop type, people are just adding that in. They're saying we need some exposure or some allocation to real estate in our portfolio overall.
Yeah, now more than ever. I mean, everybody's seen the posted numbers for inflation, and I think we could speak to 1,000 things today, but if we just really focus on inflation alone, I mean, if you look at numbers between, 4 and 7%, wherever that is, your $100,000 at the end of the year is anywhere from 96 to 97,000, and that's preposterous. And with inflation going where it's going and the cost of living going where it's going and unemployment rates increasing and coming out of the pandemic, there's a lot of people that have made a lot of changes in their lives. There's a lot of uncertainty everywhere. And there's one thing is a secured asset like a rental property has definitely become something that is sought after. We are definitely seeing a heating up of that. And if you look at the price index for rental rates over the city of Ottawa for the last even 10 years, the trend line has rapidly increased over the last couple of years, at the exception of a dip during the beginning of the pandemic. Obviously for rental, things changed a little bit, students and so on. But as a whole, everybody's looking to purchase rentals, whether that be a condo to a multi-res.
And that was going to be my next question. I know the last question sort of revolved around, the broader 10-year time frame. And as everyone knows who's looked at prices, for at least for residential, prices have shot up. We're seeing like a 18% the year before, and we're probably looking at a similar rise in terms of in prices in terms of residential. Is the rental market as hot as the residential market right now, and has it always been like that through COVID?
It's been consistent, so I don't feel like it's followed the same trends as the residential resale market. I mean, if you're looking at back in November, a townhouse could go for 680 to 700 in Canada, depending on the square footage and so on, but we'll see an average, and you're seeing upwards of 800 now, 60, 90 days later. The rental market has not seen that same type of influx in price. The demand is consistent and stable, but the growth is perpetual. And if you buy properties and, oftentimes if something's been rented for 2 or 3 years, it's under rented already because the rental rates have increased so much over the last, say, 3 to 4 years. There's huge upside, and people are buying those and getting a good deal because the rents are not there, but eventually the rents can get there and will get there once the tenants turn over. So huge opportunity there on the purchasing side. For sure.
So I had one question. I guess for anyone that's looking to hire someone as an advocate, as you know, this can be a complicated market. Obviously, you can take big risks, and protecting yourself is super important. So I guess this question, the question I'm posing is, for someone out there with no experience that wants to get involved in rental properties, what sort of experience are you looking for in an agent, and how important is that? I suppose to have someone with that specific experience.
That's a really good question. And listen, I'm a little biased, obviously, because I have a lot of experience.
No, for sure.
But that being said, knowing what I know now, I value it more and more with every coming year. And I'm always learning. And I'm still to this day, I'm learning something new every time I go out there with a client. But I will tell you is we have checks and balances in place in real estate that I find a lot of our peers don't necessarily respect. They'll go out and sell something even though they don't necessarily know how. But I think that when it comes to rental properties, there's so much at stake, especially if somebody's not like, if you've got a cousin or a friend or somebody that's been referred to you and they want to buy a rental property, say, well, I can help them out looking something simple, 800,000 or whatever for a duplex, or no harm done. But if you don't position the sale properly, if you don't structure the agreement properly, if the due diligence in it is inadequate, you are potentially condemning your client to financial ruin. And I say that slowly and with the utmost respect to my peers, but if you don't know what you're doing, don't do it.
Yeah.
Not in this field.
Well, for sure. I mean, you even alluded to the fact that this is an environment where most of the people you're dealing with, and I know, as you said, more people are getting to this market, but most of the people you're dealing with are savvy. So,
yeah.
And to that extent, I suppose there's a higher level of, experience on all sides, right? So if you're not bringing the same experience to the table, in some ways there's things that you can miss. And obviously you said that there's checks and balances, but you could commit to something, that's totally legal and still end up sort of underwater, which is crazy.
Yeah. And just to be clear, because I'm not trying to make it sound like it's the end of the world. It's more when you're trying to buy a rental property and you're spending that kind of money, everything changed from structure, street to street. There's so many things that come in, and clients are relying on you to give them expert advice. That's why they hired a realtor. If you don't really know anything about multi-res and you're going to buying a property, that client could possibly be better served under customer service buying through the listing agent than they would with an agent, because under customer service, the listing agent does have to give honesty, integrity. And if he's an expert, he'll at least explain to you certain things that have to be present in order to make sure that you know what you're buying. There's a buyer beware, versus if the person that doesn't know, there is no buyer beware. There's a risk there, right? So that's the difference in this situation. Yeah. Now, as far as people going out and buying, I fully support it. Like going and buy rental properties. Like we were just out there today, actually, we kind of had a bit of a chuckle about it, looking at a fourplex across the street that had sold, 4 or 5 years ago for $550,000. And that same building is probably worth $1.2 million to $1.5 million today.
For sure.
Buy a couple of those. you're in good shape.
Yeah. So I guess we've alluded to a bit, to what kind of experience you want in an agent. Let's say a client comes through, new client. What are the sort of questions that you're going to ask them, I suppose, to orient them or prepare them for buying an investment property, or perhaps even to qualify them if it's the right choice for them?
Yeah.
That initial interview, finding out what your goals are. Obviously, a lot of the time when we're looking at real estate with people, we uncover a lot of things throughout the process. Perhaps, someone thought that they wanted a multi-unit cash flow type property and a Vanier, and then you end up, going through the process with them and you realize that that's not their cup of tea. So I suppose what sort of things do you think people should think about even before even starting, or what are you going to ask them, to orient them in the right way?
Yeah, that's a great question, actually. And I think that's the basis of everything that we do in buying rentals and the big part of it is how you start off. So very simple question. It's kind of like when you go, I don't know if you ever bought GICs or mutual funds at some point in your life. Yeah. They sit you down and they've got this questionnaire that you fill out. It's very similar process. The first thing we want to do is we want to establish what is the risk tolerance of this person. Are they looking for something that's going to be high risk or low risk? And what's their risk aversion, right? That's first and foremost. Because once you establish, once you establish where they're at on the risk side of things, yeah, then you know what type of product you could sell them, right? And I'll explain to that a little bit further as I get into the second part of it. So first and foremost, establish risk. Second part of it is establish their short-term, midterm, and long-term goals. Now, why is that important? Because some people are buying for different reasons. A perfect example of this would be, well, I want to retire in 10 years and I want to live off of the income. Yeah. Okay, great. So cash flow is super important. Or somebody says, well, I've got, $150,000 or $200,000 in my pockets, and I need to do everything I can to turn this $200,000 into $1 million as quickly as possible. Okay, great. That's another type of property. It's another product that we're going to sell them. Or somebody says, I make really good income and I'm trying to park my money into an asset. I want to put as much money as I can into that asset, and I want the return to be how I live off of my investments right now. Right? Again, that's another product. So it is 100% extremely customized. And every time we sit down with somebody, we're going to have a different approach as it's based on what is it specifically they want to achieve. Yeah. So, you're really just trying to fit them for the right product to fit their objectives. So when it comes down to it, we have a whole market full of properties, and you immediately, I suppose, can make the search easier by cutting out a certain section of them and sort of focusing on what makes sense. Yeah. Also, involvement. Sorry, last one. When you're saying that, involvement. Right? Because then we're talking, are you buying a property that requires property management, or you're requiring a property where they can run it themselves? And that's super important as well. Yeah,
I'm sure there's a lot of people who initially thought that being a landlord was going to be really easy, and then they end up with, problematic tenants, and we can talk about tenants later on, but having good tenants is super important. And, a lot of these rental properties can be quite involved, obviously. They can be a lot of work, and in some cases you can find stuff, if you want to pay a premium, of course, that are a little bit more autonomous and can run on their own. One question I had for you, a lot of people, I guess, might feel as though, especially with where prices have gone, to some extent, that they might be priced out of maybe a central market. And what I was going to ask you was, what are your thoughts on small town assets? Maybe the risks or rewards. I know I personally have a lot of clients who, might not be in the price range to buy something that's central in the glebe, but they want to invest. They have a single family home or whatnot that they want to live in, and they're looking at small towns like Smith Falls, Carleton Place. What's your outlook on small town? Mm-hmm. Do you think that there's a place for it in the portfolio, and obviously it comes with different risks?
Yeah, you're spot on when you're talking to your clients about that, and I think that's a very good direction to point people in when they're budget conscious, and especially small town is one thing, but if we're talking about areas like Richmond or Carleton Place, places like that, I don't know where I stand on Smiths Falls. But
I mean, you have to ultimately have people that are going to rent in towns like that. And a lot of times when you have maybe a big employer, leaves, you have a hard time finding tenants, right? So there's a lot of, I guess, maybe geographic risk.
Correct. And again, it comes down to their portfolio. So what I would say is if you're trying to buy multiple assets and then you look at Smiths Falls because you're going to get good value and there's good, decent cash flow because the income's pretty good there because there's industry, but it is a one industry town, as we know from what happened with Hershey and so on. Mm-hmm. That's a risk. And I would never, what I would tell you 100% without a doubt, if you've got a client that's looking to build wealth and they have access to money to buy one property, I would not be going into that area of town because of the risks associated with a one industry town, right? I grew up in a small town, Kapuskasing up north.
Oh yeah.
And just a rumor of a mill shutting down. And our town, I remember I was a kid, went from 12,000 to 9,000. Overnight houses were up for sale and they couldn't even sell, gone, nobody to buy. So I know what that looks like. And it's not somewhere I'd want to have my principal property or my principal asset, but in areas like Richmond and Carleton Place and markets like that, good value, good rentals. And you've got tons of upside as, we'll say Richmond and Carleton are the new Stittsville. Those are really forward-thinking, smart investments for sure.
Yeah, and I know even in some towns like Markville, I guess you got to be looking at all factors, right? Yeah. I mean, you have a lot of people that are starting to, especially the baby boomers, our biggest demographic, and you see that a lot of these small towns you're having seniors kind of flock to, right? So maybe a town like Perth, which seemingly has a pretty solid local economy, and a lot of people want to retire there. So you got to, I suppose, look at all things considered. But maybe the best advice is when you're looking at a small town to look at it individually, assess the risk, and then go from there. Because it certainly can be advantageous to look at some of those smaller markets too. So maybe this is a bit a more straightforward of a question, but I know a lot of the listeners out there probably don't have a ton of experience. So what I wanted to ask you is how does one earn return based on a rental property? I know there's sort of multiple streams or multiple ways that you can earn money on a rental property. Obviously, if you buy a stock, if the stock goes up, you sell it at a higher price, you make that amount of money. And I know with rental properties, we obviously have, principal repayment, equity growth, that kind of stuff. Yep. So maybe you could go over a bit of, how real estate sort of is that, an engine when it comes to returns, because there's so many ways that you end up earning.
Yeah. I mean, that's spot on. I mean, that's one thing you should be talking about with your agent when you're looking at purchasing a property is your ROI, your return on investment. And that's essentially a net calculation of all the methods of the combined returns minus the expenses over an extended period of time to give you an ROI. And, ROIs are very, very, they're great if you're comparing them to like a stock market or so on. And the three methods of return that you're going to see on an asset, like a multi-res, is going to be your cash on cash, your principal pay down, and your accrued appreciation. So cash on cash is simple, is what's the money you're getting back on your money down, right? Or whatever investments you're making, right? Yep. So you put $1 in on a renovation after, like, say you purchase a rental property down payment and $50,000 renovation, and you increase the rents by $1,000 a month, $12,000 a year, so on and so on. Well, then you're looking at, a return of investment of X. Your principal pay down is as the tenants occupy your property, they pay down your mortgage, the principal on the mortgage. Well, that's another rate of return. So if your mortgage is $100,000 at the end of the year, it's now $90,000. Your principal pay down is 10% on that year. Okay, now it's not a real figure, but just theoretically speaking,
for exercise
sake. And then there's your accrued appreciation, which is the rate of which the asset appreciates on a year-over-year basis. So if the asset appreciates by a 10% over year on, say, $100,000, you're $10,000 at the end of the year. Your $100,000 is worth $110,000. If you do the math, if you've had the accrued appreciation and your principal pay down, you're positive $20,000 in your year, for example, which is a 20% return on, if say it's $100,000 investment. So your ROI, it's a good number. And that's why people love real estate. It's secure, it's safe, and the returns are incredible, especially in a good market like what we have here.
Yeah, for sure. And I think you had touched on it before. We had a conversation at some point. And I suppose that question kind of leads into the next question. And the next question was, what are the benefits of investing in real estate over traditional risk assets like stocks or crypto? And I remember you had said, well, Joel, it's the leverage element.
Yeah.
Can you maybe give us a little bit insight on that concept?
Yeah, sure. Joel's on fire. Yeah, it's phenomenal. So if you put $1,000 in the stock market and that $1,000 goes up by 10%, it's $100, right? So 1,100, you've done quite well. It's 10% return. Great. But when we're talking about the amount of money that you put on a down payment on a house, so let's just use an easy number, $1 million, 20% down plus your cost, but we'll just say 200 just for exercise sake. You've put $200,000 down. Okay. Your input, cash in, is $200,000. Okay. So now we're looking at a year from now, if the asset itself has appreciated in value by 10%, the same as the stock market, right? The 10% on $1 million is $100,000, right? If your $100,000 or your $200,000 is in the stock market with a 10% return at the end of the year, your rate of return is much less.
Definitely.
Right? So simply put, your $200,000 is going to get you a far larger rate of return buying a secure, safe, tangible asset than if you put in the stock market. Now listen, I invest in the stock market. I invest in cryptocurrencies. I invest in real estate. But at the end of the year, my rates of return on my real estate assets over the last few years have far outweighed the return and the risks incurred for those other two markets.
Yeah.
Doesn't mean they're bad.
Yeah. And there's something tangible about them. And I remember I did a finance degree and I was always had a fascination with Wall Street and stocks. And then I remember I had this aha moment where I liked the idea of something that was brick and mortar, something that was tangible. And I suppose you get, worst case scenario, you get into trouble with, maybe a real estate investment, and you know what, you can always pull up your bootstraps and go in and paint it, go in and sort of lift it. And in some cases with some of these convoluted financial assets, unless you're really good at reading balance sheets and you're going to be going for the long haul, like Warren Buffett or something, I know with the call options, everything else, it's, most people lose money in the market. So this is there is a simplicity. It's still a complicated market, but there's a simplicity to be able to go in and look at something and touch it. And if you want to improve it, you can, which kind of segues to another question I had for you. I know that we have a ton of residential homes here in Ottawa, and I talk to a lot of clients, and I know with aging population, a lot of people want to, perhaps create an in-law suite, or they want to just rent out their basement. That seems to be, maybe what I would perceive as the logical almost first step kind of for a lot of investors in terms of improving a property and maybe getting into the rental game. Maybe you own a house right now and you got a side entrance or something, and you want to add in an in-law suite. Maybe you could go over, the steps to kind of looking at whether that's feasible, and maybe any advice for someone that maybe has a big empty unfinished basement that maybe they want to throw an apartment down there.
Yeah, that's a really good that's a good segue for sure. And we'll put it this way: if you have empty space in your home, your principal residence, depending on the zoning, mind you. If you're in an R1 zoning in like a Canada or something like that, it's going to be a little bit different. But let's say you live in Nepean and you have a bungalow and you've got an empty basement, you're sitting on untapped gold, right? And why I say untapped gold is with a little bit of money, you can solve pretty much any problem. And if you live in, just using Nepean as an example, if you live in the Nepean area and you have a bungalow and it's worth, $650,000, and you have a mortgage that's not been taken advantage over the last couple of years, quite easily, a phone call to the bank, a renovation loan, $70,000 maybe, and you have yourself a 2-bedroom apartment in the basement, and you don't have to have an access to the basement right away. Many companies can now cut in a side entrance, and it's not as complicated as you think. They could throw a door in the side, dig it out, and that could give you probably an extra $100,000 to $150,000 to the value of your asset, and the rent down there would probably carry your mortgage. So
yeah, so I mean, you borrow 70, and then all of a sudden on paper you're worth 170, and then obviously there's that cash flow there too. And
exactly.
And we know how strong the rental market is. You know, some of these basement apartments, 3 bedrooms, you get over $2,000 a month.
Yeah.
Which is, if you've had the house for a long time, you probably, could have purchased it, for 100,000 a while back. And then you're at a point where,
Yeah. Like, and when you hear about these people that do these reverse mortgages and so on, and I mean, listen, everybody's got their views and perspectives on it. But what I would say, if somebody walked into a bank and they go for a reverse mortgage, I think the smart thing is to send them back and put an apartment in the basement, especially if it's, grandma been living there for a while. Get a property management company, get somebody to finish up the basement, spend $80,000, and then live off of the money from the rental income. If your house is paid in full, or if you've got grandparents or family that have this kind of an asset, before you go in and you look at these types of mortgages and options, I would look at setting a nice, safe residual income. Imagine, you've got a family member living in a bungalow, just like we talked about, right? Then they go $2,000 in the basement, and this person says, "You know what? I'm done. I want to travel, right? I want to stay here. Why in God's name?" And listen, we'll sell your house, no problem. We'll put the equity in your pockets. But why in God's name would you do that when you could turn around and rent the upstairs, the downstairs, if you're mortgage free, minus your costs, right? You're looking at $3,000 to $3,500 a month in your pockets net. You could go down to Florida or whatever and live a real nice life, and you don't have to worry about a thing, and that rent is always coming in.
That's some, some good advice.
Yeah.
Which makes sense. One of the big things, obviously, I know when it comes to rental properties, and this, goes down to keeping more money in your pocket, of course. And when you get to that point where, you're starting to develop assets, there's always the government's hand that's sort of coming after everything that you have. Not to be too morbid but I'm obviously talking about taxes. And I know that there's a lot of ways, I suppose, that you can limit your tax exposure through real estate, through investing. So, do you have any broad tips for people out there, at least in terms of maybe how to structure stuff when it comes to taxes and reducing taxes?
Yeah.
Maybe even in terms of capital allocation, in terms of where they're holding that equity.
Yeah. And I'm going to do that thing where I say I'm not a financial advisor or not a tax specialist. This is not financial advice in any way, shape, or form. This is something that I'm willing to help share. People have used these different ways. For sure. But to put it simply, okay, if you have a principal residence, like what we mentioned, that bungalow, you sell it. If it's your principal residence, obviously you're not paying taxes. But if you have a secondary dwelling or third dwelling, a lot of times what happens is, how do you maximize the return on that investment, right? The second you start selling and disposing of assets, then you're going to be paying your capital gains and or your taxes, depending how you structured your tax planning. Mm-hmm. Now, when you take out loans on those assets, then you're not paying taxes on those, right? So I have clients of mine that literally live off of not the rental income, because that's a taxable income, right? So for example, we just did the scenario where grandma's renting out the house, $3,000 net in her pockets. Well, there is a tax that comes on that, right? But what if you've got somebody who's looking to build a future for themselves where they really want to live on the cheap and tax-free? Imagine if you have 10 properties, okay, and every one of these properties has a mortgage. And at the end of every year, you remortgage a new property, and you remortgage to the amount that you break even in its entirety. It means all the expenses, everything is covered. You don't have to spend a dime. Yep. But that property is completely break even. But in 10 years, you refinance it, you take out $200,000. 10 years of property, $200,000. You could be taking out, for example, 10 years worth of equitable growth on each of those 10 assets, in line 1 year after the other, and you're living off of tax-free income through mortgaging, which is being serviced down and paid down tax-free. Now, eventually,
it's a rinse and repeat almost, to some degree, and there's a lot of strategy that goes into that.
Yeah,
and obviously picking the right assets, but there's a framework for being able to do that.
Yeah, well, I mean, if you look at the 100-year trend line for real estate, or if you even look at the last 10 years, you're on an upwards trajectory. And the reason why I use 10 years is 10 years is the magic number that most of the investors will like to use on their returns on investment. They can guarantee a pretty decent number on a 10-year based on the 100-year trend lines. And the last thing, obviously, just to say with that, keeping in mind, yes, you're refinancing, but you're doing growth. And what happens is at the end, if you're depreciating the asset, again, depending on how you're doing your accounting, at some point, you will need to pay taxes. Okay. So there's no true escape to the tax man. There's just finding ways to
defer it, I suppose.
To defer or reduce your implications. But that's advice for a very well established CPA. That's what I would go see my CPA for that.
Yeah. And it's always good to have, your CPA and your legal, and when you're starting off on a venture like this, sometimes it's good to develop a bit of a team, right?
Absolutely. Like
somebody that's good at everything. I know you have, you maybe have your somebody with the legal hat. You have, your obviously we know how hard it is sometimes to find a good contractor. Yeah. You want to really align yourself with those people, and sometimes it makes sense to do projects, maybe diversify a bit of the risk. Yeah. Pick a good team. Obviously, you want to be in bed with people that you trust. That takes a while too.
Yeah, team is everything. I agree with that.
I know, people don't always love talking about COVID, but I figured I'd ask a COVID-19 sort of related question as it sort of relates to the real estate market. I know that a big rental investment market, and maybe it's even almost its own market in itself, was the student rental market. And I know obviously with kids not going back to school, that may have affected that market. Mm-hmm. Do you have I know you probably do, you have some experience in the student rental market. Maybe how does that differ from your sort of traditional markets? Obviously seasonality and quality of tenant. I mean, I know when I was in university, I held quite the shaker from time to time. So there's that risk too, obviously, of property damage and stuff like that. But certainly a lucrative market if you're in the right university town.
Yeah, I mean, Ottawa's got 3 major universities, right, within like 15 minutes of each other, and there's a pretty big student population here. So a couple things about what you mentioned. The first off is COVID did put a damper on the rental market for sure, mostly during the states of emergency when those declarations were made, mainly the second one. And then because at one point at the beginning, we actually had bidding wars for quite some time. I don't know if you remember that. It got a little crazy.
For sure. Yeah.
Then that slowed down, tapered off. And then we ended up in the second wave where things actually started slowing down and rental rates actually started to diminish a little bit. But ironically, the rental properties were still appreciating in value at a fairly aggressive pace. So that was a little offsetting, and I think that everybody, my investors included, kind of took a little step back and said, hold on, let's just take stock and see what's going on here, because the trends were not consistent. So there was a bit of that, and then obviously now things have started to pick up again. I do sell quite a bit of student rentals. I have for quite some time. It's a phenomenal product to sell. The reason why it's a great product to sell is because they don't appreciate in value quite as quickly as, say, a regular property. So the advantage is that you're getting a property that more likely will cash flow.
For sure.
The disadvantage is, Yeah, go ahead.
No, I was just going to say I totally agree. I was going to agree with you on the cash flow thing. And in many cases, you're getting into cash flow type properties where maybe you're doing a valuation based on doors too, right? Yeah. And if you can get an 8-bedroom house, obviously you're not going to necessarily get a family that's going to pay the sort of higher margin per door cost, right? And the development, even stuff like rooming houses where you're dealing with significantly less square footage, but you're still cash flowing. So.
Oh yeah, you are, and so. Those are some of the advantages. On the disadvantage side, obviously, is the first is the amount of money you need to put down on these properties. The cap rates are higher. The higher cap rates means better for the buyer. But then you have higher down payments, which is part of the reason why the cap rates are higher, because you can almost pay 2 for 1 on down payment dollar per dollar for assets. So if you can afford to buy 2 4-plexes, purpose-built 2 bedrooms and 3 bedroom mixes, it'd be the same down payment as a student rental, or equivalently half the price, right? Because your down payments are higher. Now, the other thing as well is the outlook for rental properties right now on the student rental side of things. The outlook is good. I do not property manage student rentals. I sell them and I help my clients out, but I don't manage them. The room by room thing is a little more than what I want to get my hands in right now. But there's tons of great companies that do it. Some of my great friends and peers operate companies that's their entire platform. And the outlook overall from the consensus of the people that I've spoken with that are in that segment of the market quite aggressively is that the demand is coming, and
for sure.
building projects and so on are starting to ramp up again, and buying of assets that will lead to more of this housing is ramping up. So I feel like the overall outlook is positive, and I think that there's some money to be made there.
For sure. I mean, if you're satisfying a need, right? I know when it came to even zoning for the city, when we had all of this requirement for student rentals, and students were sort of pouring out into all of the neighboring neighborhoods, and to some degree, as I said, if you had a greenlit project, and it was, or if you didn't have a greenlit project, the city was more aptly or more likely to work with you if you were going to sort of scratch an itch, and sort of help with that, which kind of leads me to another question. Maybe put on our developer hats a bit. I know obviously whenever we're looking at building sort of a purpose-built rental, one of the main, I suppose, places that holds a lot of the chips or the power is the city. What experience do you have working with the city? And, I suppose for someone who is ambitious to perhaps do an infill or a purpose built, what kind of advice could you give them before they even start? Because I know the city can be very slow, and having a good relationship with the city is probably key. I mean, you could lose a lot of money. Alternatively, as I said, if you can scratch an itch, and the city's wants density, which I'm sure that they do, then you could be in a position to make quite a bit, but it's a definitely more complicated thing. So in terms of zoning, what are your thoughts?
Don't do it. Well, it's a half joke. It's a half truth in every joke. I mean, listen, there's money to be made there too, for sure.
But lots of pain.
Oh my God. I mean, I've done some myself. I've consulted and worked with my fair share of clients that do it as well. And I do alongside with my clients, either from a consulting role or supporting role, or just participating. Now, how do I explain this? I'll say, like, there were some changes over to the zoning in the not too long past, and there were some really good sentiment about where they were going with the zoning intensifications and increasing the amount of units you could put and so on. But I equate it to the city of Ottawa coming in and giving you a brand new shiny bike, but neglected to put the chain on it. So you can pedal as much as you want and it's beautiful, but you're not going nowhere. And I'm talking about on the smaller scale. People are looking to buy and build, infills, semis or duplexes, 4-plexes, 6-plexes, 12-plexes, whatever. The zoning through the site plan approval process is quite cumbersome. It's complicated. It's difficult. There's studies this, study that.
Expensive.
Costs, expenses. Non-refundable deposits for applications and so on. And then the development fees, the park fees, the land fee, this fee, that fee, tax, this, that. It's outrageous. It's like everybody's got their hands in the cookie jar except for the guy taking all the risk, right? And ironically, the lenders are making a ton of money. So the only person who is really not making all that much money, that's doing all the work and the logistics and coordination, is the one actually making the least amount of money. And I don't find that's a very advantageous for infill of our city, for the continuation of deflating some of the housing prices in the city of Ottawa. I think the policies, in my opinion, are garbage, and I'm sorry if there's anybody listening to this has a problem with that, but
I know there's been a huge push, and even in terms of policy, I mean, we're hearing of even in terms of government, they're saying, we need 1.5 million new houses in the next decade or whatever, so half the population of Toronto in new houses. But then on the other end of it, they're not really doing things to facilitate development. So, and I know that that's sort of a dynamic thing. knowing how the ins and outs of the politics work certainly are something that you're going to need to look into before you invest capital, or certainly before shovels go into the ground. So
yeah, I would say before you put a shovel in the ground, get your feet wet with some renovations and some, maybe some flips and things like that, and get a sense of thing. Because if you screw up on a small flip, you could probably bounce back on your feet, probably be fine, even probably still make money in this marketplace, because time is your friend. But if you do it in a development project, you could be in some pretty hot water pretty quick.
So I think the moral of the story there is, you just like anything else, you want to gain some experience, you maybe start with something a little simpler.
Yeah.
By the time you get to something like, erecting a structure or something, at that point, you've probably already have enough lumps and probably enough battle scars along the way to really know whether it's going to work. So
yeah, I agree.
I know in terms of valuating properties, we have a couple ways that we can do it. In many cases, we can look at, comparable units that have sold. We can look at replacement costs. What would it cost to build something like this? But ultimately, I know there's sort of a generally identified way of evaluating rental properties, and that's cap rate. And it's probably something that's really foreign to a lot of people. Maybe you could discuss cap rate a bit and how you use it to value properties, why it's used, and give people maybe just a Cole's notes on the concept of cap rate.
Sure. Quite simply put, a cap rate is the dividing of your net income by the purchase price. Right? Simple. And that'll give you a percentage. The city of Ottawa is anywhere from the high 3s up to 5 or 6%, and commercial higher than that. Cap rates on the commercial side of things are, they're quite accurate because the classes of those buildings tend to be pretty consistent, and the uses are consistent, and there's a lot less variables that come into play. When you're looking at cap rates on rental properties, purpose-built rental properties, there's a few things that you need to consider. I'm a huge advocate of cap rates. I find that they have a place in the market. And there's a lot of people out there that would disagree, but I think it's all in how you use the number that matters, right? So it's not what you have, it's how you use it.
Definitely.
Right. Yeah. So I would say the most important thing is taking into account that the cap rate puts everything on a singular unit of measure. Okay. So for example, you've got 5 duplexes side by side. Okay. If all 5 of those duplexes are similar in nature, all on the same street and all have the same build, then if you're using a cap rate from the last 3 sales, then you can pretty confidently define the cap rate of the next sale. I mean, it's quite consistent. But where you get into snags is you've got, like, for example, a 4-plex that's being sold for land value, and the land value far exceeds the value of the property because it sits on a large lot. And that's the mistake that a lot of people call me when they're looking for valuations in their homes. They'll say, well, my neighbor's property sold for like a 3% cap rate. It was only 4 units. Mine's better. Like, yeah, sure. But that was on a 66 by 120 foot lot in R4U zoning, which allows for planned unit development, with some minor variances, which means the land value far exceeded the use of the building itself. Right. So that wasn't necessarily a cap rate purchase for the property.
For sure.
So there's a lot of variables that come into that.
Because it is it's bringing the valuation to a single number. It's kind of like seeing the stock price and then, extrapolating outwards. So it's probably the best place to do a starting point. Yeah. And I know, if you're looking at cap rates in the glebe, they're probably lower than cap rates in a place like Vanier, where the expectation is higher cash flow. You're really, I guess, looking at that number, and then you're comparing it to other like properties, and then beyond that, certainly the devil's in the details. But
that's right.
It's nice to know that internal rate of return, and it somewhat is associates with risk too, right? So you're gonna need a higher return on a riskier property, and as we talked about small towns earlier, in many cases you're gonna require a higher cap rate or higher rate of return on a small town that's deemed hypothetically riskier. So that's right.
Yeah, basically risk reward, right? It's a simple way of doing it, and then the variables that come from that. That's where you start to add. Like, for example, last thing I'll add is I took a stock trading course a couple of years back, and one of the things that the guy said that always resonates today is when you're buying anything, even stocks, you have to have a strategy, and you never stray from that strategy. And why is because it's consistency in your trading patterns. Don't let emotions cloud your judgment. So one of the things he said was there's 1,000 different ways and 1,000 different measures you can use to decide on what a good stock buy is not. And one of them was, for example, the Fibonacci, right? If you guys probably heard that. I love the Fibonacci when it comes to retracement patterns and so on in stocks, but it does not define when and where I buy. It is a unit of measure that I use to establish a guideline of something I'm willing to look at. Then I start to dissect from there. Is this a good purchase? Is this a good buy? What are my risks and so on? And then, for example, you buy a stock, who is the CEO and so on. Right?
Yeah.
Same thing.
You got a big toolbox full of different stuff. So
that's right.
You're looking at everything at once. So, it might not just be the, 50 Fibonacci level. It might also coincide with, some volume indicator and also some fundamental stuff for some news or some headlines. And so when the stars tend to align, that's when you say, okay, I got multiple things that are working out here. So it makes sense to kind of go ahead. This question's, I suppose, a little bit more looking into the future, as we're kind of getting closer to wrapping up here. I was recently just I had a meeting this morning. I'm on the condo board at the 199 Slater. Got a couple rentals there, short-term executive rentals, which have been great. We actually were able to Airbnb them early on, but with Airbnb, there's always sort of a timeline before your short-term rental becomes troublesome. And I know that Airbnb's always had issues with that. So in any sense, I'm able to rent them out for 30 days, but neither here nor there. I had a meeting with someone that was looking at infrastructure for the garage to put in charging stations. We're now at that point where we're seeing 2, 3, 4 Teslas in our parking garage, and we're looking at adding in charging stations. So I guess what my question is, in terms of perhaps electrification of stuff, building materials, sustainability, LEED certified, how quickly do you see sort of, maybe not how quickly, do you see sort of any opportunities in maybe sustainable stuff, or maybe rentals that, are on the edge? I know obviously vacation rentals, and I know you had some experience even in, pods and stuff like that. Yeah. Where do you see some frontier, I suppose would be the word, some frontier opportunities?
Yeah. And I think that we're at a stage in life where we're due for the next stage of evolution in housing. I mean, it baffles me today that we still have people building houses outside in the middle of winter, right? Where the process of building a car is being done by robotics and in some cases printed.
3D printing and stuff
3D
like that,
printing,
sure.
Like they're printing things, and we're still bringing hammers and nails to a job site for construction.
Yeah. And there's even almost a taboo with some of these prefab places, or built-in factory and then assembled. So
I find it interesting that somebody, if I showed up at your house with a toolkit and a car in pieces and I had to assemble it for you, no matter how good I was, you'd be so skeptic. But if I show up at a house with somebody and they say modular construction, we go, ooh, yeah, I don't like the fact that was manufactured. Well, it's much better
in terms of air, efficiency, air tightness and stuff. It's built in a controlled environment. You're not going to get those gaps.
Yeah. So modularization to me is the way of the future. And, I've been back and forth on that for quite some time and trying to ramp up something that would be meaningful, that could take something to market that makes sense. But obviously it's a big machine to move. So modularization I think is something that is coming. It's imminent. And I think we're going to address the housing shortage. Manufacturing homes in a modular format that makes sense is definitely where we need to go. Otherwise, I don't see how we can address the problem with the way things are right now. As far as sustainability, I mean, I was chatting with the group earlier, like life goals for me. My wife and I, one day retire to Indonesia when the time is right and build houses out of bamboo, because believe it or not, it's one of the most sustainable materials on earth. And I don't know if people know this, but bamboo's got this higher tension strength than steel. So it's and you could grow bamboo in a matter of a couple of years, a full strand of it. Even less than that. So it grows fast. It's efficient. It comes from nothing. It's basically a weed.
Yeah. I mean, even in terms of of density. I mean, we're seeing families, multiple families live in the same homes. And I think people are going to some degree, get used to using less space, sharing vehicles, all that jazz. So certainly
multi-generational.
Exactly.
For sure.
So yeah, I know you have a busy day. I have some showings coming up too. I'm very happy that we were able to do this. So what I'm going to do is end it off with, I suppose, a little bit more of a speed round. So in that question, I'll have just a couple quick questions. They're mostly related to the same thing. So in your opinion, if you could have one Vanier cash flow property or Glebe for the equity play, which would you prefer? Which do you prefer? More of an equity play or more of a cash flow play?
Vanier, hands down.
Cool. And I suppose, not to answer for you, but the ability to lift some of these properties.
Near Beechwood, all day.
And, even just to touch on that, I think we had a conversation back in the day where you actually said, what you ask people is, what's your risk tolerance?
Yeah.
And a lot of people would think that the risky property would be the Vanier one to some degree. But I remember you had said, well, no, the Glebe one is, you're actually paying premium for it. If you wanted to come in and lift a property, if you have that ability to lift it, your risk goes down.
Yeah, absolutely. That's a perfect observation. Yep. You're 100% right there.
What's your favorite food?
Pizza for sure.
Pizza for sure.
Get me some pizza.
And then, purpose-built infill or renovation. I think we've already answered this question.
Renovation all day, bud. All day.
Dealing with the city. Ethereum or Bitcoin?
Ethereum, hands down.
Very nice. Very nice. High-end tenant, luxury rentals versus multi-unit, lower income or student?
Multi-unit, lower rentals. Cool. Subsidized housing all day.
Awesome. Favorite place to vacation?
Mexico, but I'd say Mexico's where I like to go for short-term vacations, but by far Indonesia, Bali, where my wife is from, take me there. It's obviously a 26-hour flight. So
for sure. So when you get over there, you got to invest in staying longer.
Exactly.
Travel time.
If I had to choose, though, for sure, it'd be in Bali every other month. Without question.
What is in terms of real estate, I suppose, what is the worst investment you've ever made?
You said this was going to be a speed rounded short. I'll give you a long list of bad investments that I've made. I know we all have. And I think, to some degree, taking part and learning and is probably in some cases more valuable than not taking part. And I know a lot of people, I speak to, it's like, if the sooner you get the first one out of the way, the sooner you get to the second one. So to some degree, if it's not perfect, but it mostly works, that can be good. But. Well, absolutely.
I don't know if you have a story.
No, I'm definitely not gonna be sharing stories because I don't want to get sued or slandered. But what I'll tell you is the worst investments I've ever made is investing in, time and money in partnerships that led to nothing. Wow. One thing that I learned in business as I get older and as I get more mature, obviously, is that, bad people screw you, and you can't be screwed by people you don't let screw you. And what I mean by that is you're always going to have somebody's going to try and take something from you, because there's a world that people add value and there's a world the people that take from you. And there's one lesson that I learned over my years is that if they take from you, they may take something that is valuable to me, like money or an asset or something, but I'll never let them take a part of me or who I am. I don't let it bother me. I move on.
No, for sure. Time. That makes a ton of sense. Yeah. And then on the other side of it, what's the best investment that you've ever made? Because obviously we want to hit the positives here.
Yeah, I mean, I've had quite a few really good ones, but one that comes to mind is my business partner and I. Mean, so all a series of business partners, but our business partner, we had purchased a cottage, and the irony is, there's a moral of the story to this, and I share it all the time with clients. Is it was for sale for $450,000 6 months prior to us looking at it on MLS, which means we could have bought it with commission and we could have reduced the price and got it for a deal. We could have probably walked away from that at about $400,000 net, right? That we would have paid. 6 months later, we hadn't seen it, but anyways, that was the story prior to it. We see the property privately.
I think I was there. I think.
Yeah,
you
were
renting
there.
A short term. We had a little party there.
Yes.
Beautiful spot right on the river.
That's right. That was the one. So we ended up $550,000 net to the seller, at that time, and they were quite adamant they weren't moving and the market was going in their favor, and they said, screw it, that's our price, take it. And we kind of hemmed and hawed and said, do we take it, do we not take it? It's like, we were $150,000 more, We danced and played, and finally we said, screw it, we took it. 18 months later, we sold it for $875. So do the math. We did quite well.
Yeah. And I know, being involved in the Airbnb and the short-term rental market, to be able to rent a place like that, you're not looking at like $2,500 a month. You're looking at $2,500 a week, maybe more.
Yep.
So
$10,000 to $15,000.
I know vacation properties, which is sort of a different beast,
Yeah.
is especially with people not being able to go away or go anywhere else. So for my final question, as we wrap things up here, what's one thing that you wish that you knew before you started? So if someone could say, sit you down and say, you're going to get involved in this market, in real estate in general, what's something you wish someone had told you?
Oh man, that's a really good question. I mean, there's so many things. If I had to choose one thing, I think it would be the power of leveraging partnerships. Because I think when I started and everything, I didn't really understand or value how important it was to get a group of people together, that common interests, and use the power of that to achieve goals, including purchasing real estate. And most of my partners or my closest friends and so on have gone on to do incredible things, and they're titans in the world right now. And they did so by leveraging partnerships. And I talk to anybody who's listening to this podcast who thinks, I only have 50 grand or I only have 25,000. Well, I've got another great story to end this on. And I think it speaks to volumes to this young man who's I have the highest amount of respect for, who's been working with us and through the highs and lows. And, very young age, I won't disclose age, but very young age, purchased a rental property from us with a series of friends, and then rolled that out into another property, and then next thing you know, boom, 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 this person's doing quite well and wouldn't have been able to do that without leveraging out partnerships and friendships. Mm-hmm. And now they've split off in their own and doing their own things because they can, but they started somewhere. So leveraging partnerships is huge.
Makes sense. You can't soar with the eagles if you're hanging with pigeons. So
Exactly.
Look at that network and work hard. So
get together, work together.
Sure.
That's the way to get by.
Yeah. Well, I think that just about wraps it up for the podcast. What we're going to do is, as I said earlier, we're going to have a different guest on every week. We may even toy with some, maybe even some live shows. I am going to post some resources in the show notes, and then I'll also give you guys some information on what's to come. But on that, we're going to wrap it up with the Boardwalk podcast. And I wanted to thank my guest again, Marc Papineau, for sharing his wealth of knowledge. Stay tuned for more.
Thank you so much.